Section 22. How lower interest rates can save buyers money. Small changes can make a big difference. In the last section, we learned that mortgage rates are influenced by many different factors, including the buyer's financial profile, the loan program, and overall market conditions. Now let's look at why those interest rates matter. Many buyers focus on one question: what will my monthly payment be? While the monthly payment is certainly important, it is only part of the financial picture. Even a small difference in the interest rate can affect not only the monthly payment, but also the total amount paid over the life of the loan. Helping buyers understand this concept allows them to make more informed financing decisions while working closely with their lender. Understanding interest. When a buyer obtains a mortgage, they are borrowing money from a lender. The lender charges interest for the use of those funds. That interest becomes part of the buyer's monthly mortgage payment. Over time, each payment reduces both the loan balance and the interest owed. Although buyers often focus on the purchase price of the home, the interest rate plays an important role in determining the overall cost of financing. Why even small rate changes matter. Many buyers are surprised to learn that a relatively small change in the interest rate can have a noticeable impact on their monthly payment. A lower interest rate generally means lower monthly principal and interest payments, more affordable monthly housing expenses, less interest paid over the life of the loan, assuming the loan is carried for its full term. Conversely, a higher interest rate generally increases both the monthly payment and the total cost of borrowing. The exact financial impact will depend on the loan amount, loan term, interest rate, and the length of time the buyer keeps the mortgage. Arizona broker tip: when buyers ask, "Should I wait for interest rates to go down?" Avoid trying to predict the market. Instead, remind them that no one knows with certainty where rates will be tomorrow, next month, or next year. Encourage them to make decisions based on their personal financial goals rather than attempting to time the market. Questions about current rates or future financing strategies should always be directed to their lender. Looking beyond the monthly payment, although buyers naturally pay attention to their monthly payment, it is also important to consider the overall financing package. A loan with a slightly lower interest rate may involve different closing costs, discount points, or mortgage insurance requirements. Likewise, a loan with a slightly higher interest rate may provide lender credits that reduce upfront expenses. That is why buyers should compare the complete loan estimate, not just the interest rate. Looking at the entire financing package provides a much more accurate picture of the true cost of the loan. Real-world example. Jennifer received loan estimates from two different lenders. One lender offered a slightly lower interest rate but required additional discount points at closing. The second lender offered a slightly higher rate but significantly lower upfront costs. Rather than focusing on just one number, Jennifer reviewed both loan estimates with her lender. After discussing how long she planned to stay in the home, she selected the financing option that best fit her financial goals. There wasn't one right answer. There was simply the loan that made the most sense for her situation. Helping buyers make good decisions. As a real estate professional, your responsibility is to help buyers understand that mortgage financing involves more than simply finding the lowest advertised rate. Encourage buyers to compare complete loan estimates. Ask questions about lender fees. Understand the difference between interest rate and annual percentage rate, APR. Discuss long-term financing goals with their lender. Select financing that fits their individual circumstances. These conversations help buyers make informed decisions while keeping you within the scope of your Arizona real estate license. Your role as the real estate professional, your role is to educate, not recommend loan products. You should explain general financing concepts, encourage buyers to ask thoughtful questions, and remind them that every borrower's financial situation is unique. When buyers ask which interest rate is best, or whether they should refinance, lock a rate, or select a particular loan program, refer those questions to their lender. Helping buyers understand the process while respecting professional boundaries protects both your clients and your license. Financing terms directly affect a buyer's ability to perform under the Arizona Residential Resale Real Estate Purchase Contract. Helping buyers understand that interest rates influence affordability, monthly payments, and the overall cost of financing supports informed decision-making throughout the transaction. Real estate professionals should explain these concepts in general terms while referring specific financing recommendations to qualified mortgage professionals. Online discussion, question 1. Why is it important for buyers to consider more than just the advertised interest rate? Answer. The overall cost of a loan includes interest, lender fees, discount points, mortgage insurance, and other financing expenses. Comparing the complete financing package provides a better understanding of the true cost of borrowing. Question 2. Why shouldn't real estate professionals predict future mortgage rates? Mortgage rates are influenced by many economic factors and cannot be predicted with certainty. Buyers should make financing decisions based on their personal goals and discuss rate strategies with their lender. Question 3. How can real estate professionals help buyers understand financing without giving mortgage advice? Answer. Agents can explain general financing concepts, encourage buyers to review their loan estimate carefully, and refer specific questions regarding rates, loan products, and financing strategies to qualified lenders.